When it comes to trading, it's important that we're not just looking at the smaller time frames. We want to be looking at support and resistance across all time frames. There is a hierarchy to time frames. So support and resistance are going to occur at all of these different locations on all of these different time frames, such as the daily, the weekly, the hourly, the 5-minute, the 1-minute, the 15-minute. All of these time frames are going to have support and resistance. However, the higher the time frame, the stronger the level. The stronger the moving average, the stronger the trend line. Levels on the higher time frames are going to have more significance because they reflect decisions made over extended periods of time. So a 1-minute chart might only have been interacted with for a few minutes, whereas a daily or weekly chart may have been interacted with multiple times, multiple weeks, multiple days, multiple hours. This means there's more participants in that location. There's more shares being traded and more liquidity has occurred. However, the lower time frames also serve a purpose here. The 15-minute, the 5-minute, the 1-minute, and so on can show us intraday levels where price reacts within a session. This is very useful for precise entries and exits. So previously, when we were looking at an area that was a strong level that turned into a zone, the smaller time frames are the time frames that are going to help us understand the actual precision of our entries when we're in that general area. Back on the topic of confluence of support and resistance across multiple time frames really increases the reliability and significance of levels. This can provide high probability trading setups. If you've got something showing on the daily that then shows up on the 1 hour and then shows up on the 5-minute chart, you have a lot more signals going on across multiple time frames. So we want to use a higher time frame level to set the overall bias of the market or the stock that we're watching. We want to look at that to tell us the trend direction, if it's in a range. And then we want to use the lower time frames to really help us optimize our entries and exits. This can help us with our trade management and really understand when to get into the position or when to get out of the position. So when we're looking at the market and we're deciding to put a trade plan together, what we want to do is we want to start wide. So we want to start with a monthly, a weekly, and a daily chart. And the reason why I bring this up is because even if you trade a smaller time frame type setup, so let's say, for instance, you trade the 5-minute ORB. If you trade the 5-minute ORB just based on the fact that a 5-minute range is breaking without looking at the bigger picture, you're not setting yourself up for the ultimate success. By looking at the bigger picture and understanding where the higher time frame participants are, you can have an A+ ORB setup. If, for instance, on the weekly chart, we have a very strong resistance level, and then we dial it down to the 1-hour chart and there's a nice range forming, and then that day a 5-minute range sets up on the intraday chart, breaking that range, which is now breaking the weekly chart as well, you have higher time frame participants supporting your position and your strategy. This allows for more A+ moves and more A+ setups. So we want to start wide and then we want to narrow it down. Use the bigger time frame and the bigger market idea and the market bias to really tell you where the good locations are on the bigger time frame, then dial it down to your intraday strategy when you're close to those locations. That way you're not taking trades in the middle of a giant range and you're actually taking trades that are on the outsides of things with room to expand. So on the left-hand side, we've got a higher time frame chart. So the higher time frame is going to highlight key levels that attract interest from large institutions and investors. Whereas the chart on the right-hand side is going to be a smaller time frame chart, but it's going to offer a more precise approach for confirmations and entries. When I see a strong level on a higher time frame, and then on the smaller time frame, I see something set up around that level, this allows me to have more precise entries. Because if I'm just trading in the general vicinity of this area, it can be difficult to understand exactly when to get into the position. Now, order flow will help with this, but if I see a pattern already forming in the area, this tightens up the location where I should be putting on the position. So I know that if the lower end of this breaks, if my stop is above here, I should be protected by the top end of this range. So price action can do whatever it wants around here, but as price breaks below it, I should be protected. This allows me to play the larger time frame with the larger participants while having a more dialed in approach. Another way to combine the higher time frames with the smaller time frames is to look for fractal patterns that set up within each other. So a fractal pattern is a pattern that is seen across multiple time frames. So here we have a weekly chart on NVIDIA, and what you'll notice on NVIDIA is there's this range that's been forming. Now, as this range has been forming on the weekly chart, we could be playing the edges of the range. But as it's beginning to break out, we can start to look for similar patterns on a smaller time frame. So we have the range on this higher time frame, but when we move over to a smaller time frame, we can also see a range starting to set up on the smaller time frame. This helps us narrow down our entry point. So as price has moved to the upper end of that range on the weekly chart, here on the 15-minute chart, we have a range that's also setting up. This is a fractal pattern, and these can be played day in and day out.